Enjoy your meeting. Just a reminder, today's meeting is being recorded.
Hey everybody, this is David Blake with Tuesday Tech Talk. And today we're going to review the last couple of days in the market, try to figure out what's going on here for this week. And then we'll try to take a look at some of the different indexes and some of the sectors that might be outperforming or underperforming the market. I'll probably talk about 20-25 minutes, and if you have some questions on individual stocks or market, we'll try to get around to that. And usually these things last about 30 to 35 minutes. So thanks for joining me. Just look at last week. We had kind of a pretty volatile period again with the market. We had the Dow Jones up triple digits moving triple digits in 4 of the last 5 days. Unfortunately, went nowhere. As two up days accounted for about 397 points. The 2 down days made up 402 points. That was a difference of about 5 points between them. Momentum for the broader market still remains negative even after yesterday. Internal breadth is still mixed, with the NYSE acting much more solid than the NASDAQ. Part of that is because people are still buying the defensive sectors and also buying the stocks that large cap stocks that have some yield to them. We are getting sentiment to the point where it's getting so negative that using that as a contrarian indicator could be pointing that downside is not going to be that much in here. I'm still not expecting all that much yet. I still think we could possibly get down to around 2012 or so on the S&P 500. We'll have to see once it gets down there to see how negative everything turns. But last week, the Dow Jones and the S&P 500 both broke below their respective 50 and 200-day moving averages. Yesterday, of course, they bounced right back above them both. But today we had the Dow Jones actually go below it. The S&P 500 is still traded above it. The Dow, I think, is about 5 or 6 points above the either the 50 or 200-day right now. So you want to watch that. If it can't hold that, that would, again, be kind of a negative. Defensive sectors last week reigned supreme. We had winners in the utilities. Actually was one of the few groups that was up. Consumer staples were flat. Healthcare was off just a little bit. Again, those 3 sectors are all high-yielding segments of the market. Weakest sectors last week were mainly the consumer discretionary sector. After we had Macy's set off a round of selling in the big box brick and mortar stores. Nordstrom's was down big. JCPenney's, Macy's, all of them had poor earnings and even worse forward-looking outlook for what they could expect the rest of the year. So that was weighing on consumers. And of course, then the way this crazy market is, Friday we get a report that says that April retail sales were up 1.3%. So that kind of looks like people are still spending, but just not going to the mall apparently. Okay, last thing I want to mention is that the Dow and the S&P 500, we talked about it last week a little bit. They did form that neck and head and shoulders pattern, and both of the indexes ended the week just sitting right on the line, where if they would have broke through, it would have been a negative chart pattern for both indexes. If that head and shoulders pattern breaks, which it still can, that's going to set up a lower target than what I currently have for the different indexes. That was set up somewhere around 16.9 for the Dow, and maybe 1980, 1975, maybe as high as 1990 for the S&P 500. I don't think we're in the danger of hitting that low quite yet. We'll have to watch that to see if the neckline gets broken here this week. To wrap it up with that, the market posture is still bearish. Even despite yesterday's surge, we had a little bit of pickup in the indicators, but even that was mainly due to oil-related stocks. You're still seeing oil going up here. You're probably going to get a test of that $50 on the resistance side up there. And of course, you had Apple lifting all the technology stocks yesterday with Warren Buffett's big buy and a couple other money managers buying it was beaten up. Okay, what we're going to try to do today, part of this is in response to we had an awful lot of people commenting about the market letter Tech Talk yesterday and last week and how it can be helpful for you. whether you're familiar with it or not, on the markets page, when you log in on the right-hand side, you have something over here called Dr. Market Edge Talks Stocks. And the reason we have that up there, it's not really a stock of the week or anything like that, but what we try to do is take the second opinion and take a chart. We look for a stock that maybe has been upgraded or downgraded by a major wirehouse, that possibly may have been featured in Barron's over the weekend. And what we want to try to do is compare the fundamentals that they write about and then look at the technicals that we're about and just kind of see if we can get the two in agreement. And if they're both positive, it gives you a good stock that you might be able to add to your portfolio. And we're going to go over a couple of those this week just so you can kind of see some of the stuff that we look at. Last week, one of the stocks that we looked at was American International Group, and it was a write-up by Deutsche Bank. They had a hold rating on the stock. It was based on the first quarter 2016 results, and they kind of had they liked the stock. They think it has some upside, but they're not recommending buying it at this time. Now, if you look at the second opinion down here, get my little marker. Okay, second opinion, we went long on the stock AIG back on 420 when it traded at 55.72. Stock has traded sideways since then. The let's see, look here. Okay, sorry, I lost my notes here. The power rating is 80. The score is a 0. C rate still sees upside of about over here about 5%, something like that. But stock is near the sell stop, which we rated that as a caution. And we're going to look at some of the indicators over here are kind of mixed at this stage. So you go to the next page on here and look at the actual chart. Okay, you're going to see on this that it's been kind of a bumpy ride along here for AIG. Punched out a new 52-week high last July. Then it gave back pretty much all the gains. Up here, another little rise at the end of the year with the rally, and then it's rolled over and punched out a new low at 50.20 on February 29th. Okay, now it's starting to pull a little bit of an up move. We have a nice rising trend line, which looks okay. It's bounced off of that so far. It cleared the 50-day moving average. That's positive. And so far, it's found support up here as it's pulled back onto the trend line. So at this stage, the stock's got some potential. It's rated long on the technicals. It is moving higher on here. And what we try to do over here next is we try to give you a little summary of what we look at on the second opinion in the chart. In this case, 7 of the last 10 technical events that happened for the stock were bullish. We did notice on the some of the commentary that the stock has retraced about almost 50% of the move down from here. That's bullish. If it can clear above this area around 56.67, 56.91, which is where it actually has bumped into a couple times. If it can move from that, it can at least make a run up to the 200-day moving average and higher. So let's take a look at one more chart. This was done last week. As you can see over here, we actually bumped up against that resistance area 3 times here since this was written, but we did pull back to the trend line, which is also bullish, and so far we're staying above the 100 and the 50-day moving average. So on the plus side, we're still in the uptrend, and the trend line is holding. On the downside, the inability for the stock to break through this resistance area should give you a little bit of pause. What you want to do is, for AIG, if you're looking to buy it, you may want to hold off and wait for the momentum to pick up. As you can see, it's still bearish on the RSI, and wait for this thing to pop above the resistance level. That could give you a little run up here to the 100-day moving average, 200-day moving average, and possibly make a run back to this all-time high. But until that happens, we want to probably see this thing in the stock watch list and put it off to the side. Another stock that we had taken a look at actually from about 2 or 3 weeks ago was Johnson & Johnson. This thing was written up, let's see here, hold on. It was written up here around 419. Wells Fargo had bumped it up to an outperform rating. raised its earnings and also raised the price target from 115 to about 120, 121. Okay, the market opinion on this is long. It was upgraded on February 8th, actually, when it was at 154 cents. Since then, the stock's risen about 13%. When this was written, it was up about, which is a couple weeks ago, it was up 13%. It's up a little bit higher than that now. But the technical indicators down here are mostly positive. The up-down slope shows is down now, which shows a little bit of profit taking. So if we come over here and look at the chart, it's got a nice looking chart over here. Rich Cooley does these, and he talks about a rising wedge pattern, which the stock actually broke above to the upside on that. The up-down slope had turned down, but now it's beginning to pick back up over here on the breakout, and it's now trading above the 50 and 200-day moving average, which is a positive. If you look at the summary over here, it says Johnson & Johnson looks to be headed higher, but if you're cautious, you might wait for a pullback to the 50-day moving average, or even, since the stock is overbought in here, or at least to the upward trend line, and that might be a good entry here. Okay, what's happened over the last couple of weeks from here? Sure enough, the stock did pull back to the trend line, which coincides actually with the 21-day moving average. As you can see here, the stock has bounced off that moving average every time it's come down to that. And then we retested this thing again last Friday or Monday, and we've gone higher from that. So this thing has actually hit 115 now. Momentum has slowed, but the stock looks like it's going to work higher, and that 120 target looks like a real possibility. The stock also has a nice 3% yield at this stage, and the risk is probably more market risk, in here than it is of the stock coming in with missing earnings or something and pulling back. So even though the chart looks good, sometimes you might want to go over here and look at the sector that they're in. In this case, the healthcare sector is XLV. It's had a great run up in here, but some of the selling in the biotechs is going to hurt the healthcare spider. As long as it stays above this 50-day moving average and starts to work a little bit higher, you see some accumulation over here again. I think you can probably look to put Johnson & Johnson in a portfolio for a longer-term hold. Okay, now today we usually put these stocks out, if you're not familiar with them, on Tuesday after the webinar is done. We always have three. One of the stocks today we're going to look at is BB&T Corporation. Let me find the notes on this. Okay. On this thing, Fig Partners raised its rating on BB&T to an outperform. On 5/10, they wrote the article. They had a target on it of 39.25. Although other analysts, they point out, have actually been lowering their estimates for earnings. Fig thinks BB&T has about 15%, 16% upside. So we're going to look at this to see if the technicals agree with it. In this case, the technicals may not be agreeing with what Fig sees. What we look at it here is we upgraded the stock on 4/4 when it was at 33.51. Okay, since then the stock has been trading sideways to a little bit lower. The score is -2. The power rating is 12, and this power rating had to at least be a 59 before for this thing to have been upgraded to a long. So you're seeing some fairly strong deterioration in the stock. If we go over here and look at the chart, again, you see a nice little move off the bottom here from February 11th. It moved up with the broader market, but smacked right into the 200-day moving average, which we'll look at in a minute. It's not on this chart. But as soon as it hit that 200-day moving average, it rolled over, and since then has been working its way lower. RSI is negative. You can see up here in the up-down slope. We're also taking some profits at this stage. It has retraced 50% of the move off of this bottom, and you want to keep an eye on that. If it breaks below this stop or this low here, you're probably going to get retracement of the full move. But in this case, the summary talks a little bit about the deterioration of the stock, and it recommends that you put this stock in a stock watch list, wait for the technicals to improve before buying. And another thing I want to also consider on this thing is you can see that with the banks, they are very interest sensitive. So as we're seeing today, a little bit more talk about whether we could get a rate hike with the strong economic data that came out today. you may see the banks try to put in a little bit of a bottom here. You want to watch that with insurance companies and the banks all. If they start hinting at another rate hike, those will be the stocks that could actually help this market move up a little bit. So anyway, that's some of the things. You can look at these things, and if you read the comments that Rich puts in there, it's going to help you just kind of analyze the stocks, see what you should be looking at, instead of just taking the second opinion report as a black box type of research item and just saying, okay, it says long, okay, I'm going to buy it. You know, as you can see here, if you take a look at the chart, it might be telling you a few things that the second opinion doesn't exactly point out. You can see whether some of the indicators are improving or gaining strength, or whether they're rolling over and breaking through some support lines on that. And it'll give you a little bit better chance to pick out some stocks for your portfolio. And like they say, a picture tells 1,000 words. So that is something you may want to take a look at in there on Tuesdays after the close. Before I get to this, one of the things that is on the markets page also, some of you may have downloaded the book Trade Like a Pro. Tom Ventresca was one of the founders of Market Edge. He wrote that. He had been in the business since, I believe, back in the 70s. So he's been around the market for a long time. He talks in there about how you can use a second opinion, and the Dr. Market Edge talks stocks to to find investment ideas that are sound both fundamentally and technically. They're also strong. And but what he's trying to do on there is let you get a couple stocks. You can see that the story, they're being written up, they're in the news. Take a few minutes to see what's going on with the list. Make a list of them. Decide whether stocks are buying now, or whether the summary is telling you perhaps you may want to wait until the technicals improve, or more importantly, you may want to check to see, like in the case of BB&T, if the technicals disagree with what the fundamental story is. You may just want to put that in a stock watch list and wait and see if you see some improvement later on. And one of the things that is not in the book, but we're going to put up a link on the website here probably later on today. Tom has made up a spreadsheet in his Excel that he likes to use. It's something that you can download here later on today. It's just a way that you can track your investments in about 5 to 10 minutes every day, and pretty much know what's going on, so you're not sidetracked by something coming in here and it's broken through some support or resistance, or you're noticing a bearish chart pattern or something like that. But over here, you can put the symbol in with the stock you're looking at. Over here is do your Monday through Friday list. You can get what the opinion is on the stock. You can rate your score, your confidence rating, whether you're long the stock or whether it's on a watch list. You can decide that. And then over here, you're going to make notes of what you look at. If you look at changes in the second opinion or on the chart that you'll see over here, he says, okay, this AXP has resistance to 60, 50% retracement to 61, points to 71. It's got a big move in the up-down slope, so people were buying the stock. He thinks you can buy it probably in here around 57. That would be the 50-day moving average. So if you just make a few notes like that on Tom's worksheet here, it'll allow you to see whether the stock's deteriorating or whether it's improving. And by having a sheet like this on there, just a few minutes with your portfolio every day is going to keep you abreast of what's going on. Often, a lot of times, what you'll see on these things is you'll have a winning position. You'll be watching it for a couple of days, and you go away, and all of a sudden you come back and you bought the stock at 60, went to 66. Now it's at 50, 57. And by just taking these notes and looking at some things, it'll tell you, where you want to get out. Over here's a spot on this thing where the stop is. Okay, I want to get at 60, or I want to get out at 550, something like that. So you'll know to at least have a mental note of where you want to go. Nothing worse than trying to get a winning trade and have it turn into a losing trade. So some traders will even make sure that they don't. If they have a trade go the right way, they're not going to have a losing trade at all. They'll get it stopped out. The thing turns around, bounces back up, they'll buy back into it. But one of the things that second opinion can really do is if it helps you give you that disciplined, consistent approach to why you're buying and also why you're selling, once or twice a year if we can get you out of a stock that we recommended at 60 and maybe at 57 we've told you to get out. You can take these $2 and $3 and $4 losses in there. That's the ones if you get 50 and you end up holding stock at 20 or 25, you're not going to be making any money that year in the market. That's probably going to wipe out your gains. So with a little spreadsheet like what Tom's made up here, this will give you a chance to look at some different stocks and keep a little bit more hands-on on your stock portfolios. Okay, I want to move on right now. We had some questions during the week about some different stocks. The first two are actually in the exact same industry. It's Blackstone Group and Carlyle Group. Blackstone, not a very good-looking chart, and you can see it didn't really participate to the upside like some of the other groups off of the February and January lows. The stock was actually downgraded to an avoid today. Chart doesn't look too good. Momentum's negative. 14-day has gone below 30. Remember, if I'm looking at stocks on the long side, I don't want to see this RSI ever go below 40. So still in a distribution. You have another little sell-off over here the last couple of days or last couple of weeks in the up-down ratio. MACD also just went bearish. I also don't like the business that these guys are in right now. Volumes on the exchanges are way down. I don't see according to our CTI stuff, I think you see a flat to probably down market towards the end of the year. So with the volumes down and probably a market that's not going anywhere, stocks like Blackstone and Carlyle that get their money from M&A activity and a lot of market activity, I would think they're not going to be your best candidates. What might change that is if we get a rate hike, let the market pull back, and then you can start looking at some of these financial groups. Okay, here's the Carlyle Group, symbol is CG. Again, it has a very similar looking chart. Came up here, bounced off, and kind of rolling over, smacked into the 200-day moving average. Now it's trading below the 50 and the 200-day. You have investors are selling it over here. The RSI momentum is again below 30 and weak. And again, you have the MACD long-term has gone bearish. This was downgraded to a neutral from a long here in the last day or two also. So not in the right business, and you probably want to hold this thing off and wait again. Like whenever we raise rates and you get a trip down here on the market, that's when you may want to start looking at the banks because that's when they'll start improving. Okay, the last one that I had a question on real quickly here was iShares U.S. Real Estate. The symbol on this is IYR. You can see the big bounce over here. This is when they decided pretty much when Yellen was talking about interest rates are going to stay low for longer. We got a nice rise. That was over the defensive sectors in the market. Your consumer staples, your utilities all took a nice big run up. So was this. The stock was this ETF was really overbought over here. We've had a little bit pull back to support. So you can see over here what was resistance. They call this polarity. That now becomes support to the downside. Again, today you had with the stronger manufacturing data and stuff like that, you have people talking about whether or not the Fed's going to move sooner than later again. And the only thing about these stocks is you want to remember that once interest rates begin to pick up, and over here I think is where they started to, this is where we got the first rate hike. Boom, we went from 76, and it's worked its way lower with the broader market. You'll see something very similar to that once the rates pick up. So, they're overbought. You have to wait, and as long as tomorrow you have the minutes from the FOMC meeting, if they come out with a little bit more hawkish tone and say that the economic data is getting stronger and that they still want to raise once or twice, the utilities and the REITs may be areas that you may want to lighten up if you've got a nice profit in. That's also been one of my problems with consumer staples, although they pay a great dividend. We've talked several times in the last couple of weeks that they're trading at about a PE of 22 or 23, where normally they trade about 12 or 13 as a defensive sector. I think you'll see a lot of selling in those. In fact, But what Warren Buffett actually just sold all his Procter and Gamble, so he's the big investors know that that's going to get hit. That sector, mainly if once rates start to go up. So that's the only questions I had ahead of time. Here's a question over here. Okay, my favorites on the markets page does not have Dr. Market Edge Talk Stocks. Why? Chuck, do you have? Can you let me know if you're with a brokerage firm? And the reason I'm asking that is some of the data we have, the fundamental data we have, we get it from S&P. I am an independent RIA. I imagine then you clear through maybe Pershing or Fidelity or Raymond James and TD Ameritrade. Okay, you're with the institutional side though. Some of the institutional pro sites don't get that, and the reason being is because S&P doesn't want us to use their fundamental data for professionals. We are in the process of getting that taken away so that we'll be able to use the fundamental data on the pro side also. But the reason is that you actually buy your data from S&P, and they actually sell that to the professionals also. We pay them to distribute it to the retail clients. So I apologize that we talk so much about that for you, but I can't help you with that. But anyway, for the retail client, if you go on the markets page, you will find these the Dr. Market Edge stocks. Okay, we're right at about 30 minutes. Do we have any other questions? In here? Okay, we got one more here. As mentioned, Dr. Market Edge stocks comes out weekly. Is there ever a similar specific discussion devoted to ETFs, short of looking at all the individual sector analysis? No, you would have to do probably look at the ETF screens to get that currently. That is, again, if you've noticed here, we're adding a lot of new things, and one of the things we're adding also is going to be an overview of the ETFs to go along with the ETF Center. That's in the process, and a lot of this stuff, along with our mobile apps and things like that, are getting ready to be rolled out over the summer. So you're going to see a lot of changes in the site over the next 2 or 3 months that I think you'll really like. You'll find them very useful. A lot of the ideas that we're coming out with were asked about by you all. So we're going to try to get the stuff that you've asked about. But right at this point, no, you're not going to get discussions on the ETFs, except for if you ask me to talk about them on the webinars and Tech Talks. I try to touch base on which sectors, and also on the market letter. We also do have a little bit of make notes on what were the best performing weakest to strongest categories on the ETFs over the week. So there are different places you can find that. Okay, well, that's the 30 minutes on that. Again, I would advise you to take a look at the Market Edge Talk stocks, because if you go over it a couple of weeks, and it's really going to help you dig in and just find what the charts and the second opinion together can do for you as far as developing that good, strong, consistent, and disciplined approach to your investments. You don't want to just be grabbing something long here, taking something from that. It'll help you, again, find what sectors are better, and to take some notes on the different stocks that may be showing signs that you really can't see on the second opinion alone. And again, the last thing I'll say is that the Market Edge market posture is still bearish. The CTI is projected to stay weak for a couple more weeks. And also is Tom Ventresca's little worksheet will be up on the markets page on his ad later for you to download. That'll give you something to print off and work with. Other than that, we'll talk to you next week. I appreciate you joining me. I hope you got something out of today. Thanks.